Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Marvell technology.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave in the comments section below.
So let's get into the analysis. Marvell has really positioned itself right at the absolute heart of this whole AI infrastructure boom.
Right.
But maybe not in the way that everyone immediately thinks. The whole investment thesis here is really built on specialization. They're moving away from being just another general chip seller.
To being more of an architectural partner for these massive companies.
Exactly, for the biggest companies on the planet.
We've been tracking this AI infrastructure build-out for months, and it feels like Marvell's role is shifting. It's moving from being, just a foundational piece to something mission critical.
It is.
So what's the fundamental differentiator here? What creates this growth story? It can't just be another chip company.
It's absolutely not. Their biggest competitive moat, their real defense, is their custom silicon design expertise. They are building ASICs.
Application-specific integrated circuits.
Yes, exactly. Chips tailored specifically for the massive cloud hyperscalers. This is co-design at the highest possible level.
And we have real evidence of this.
Oh, yeah. You can see it in their engagement pipeline. They're currently involved in over 50 new design opportunities.
50?
50. And that's across more than 10 major customers.
50 opportunities. That's a staggering metric. It suggests they aren't just, winning bids here and there. They are embedded in the future R&D plans of the world's biggest tech companies.
That's the key.
And that level of integration, that has to imply serious switching costs. If you design a chip architecture just for, say, Google's internal software stack, you can't just swap Marvell out for a competitor next quarter.
Exactly. It's the ultimate form of customer lock-in. The switching cost is measured in years, not months. And this expertise is doubly validated by their focus on high-speed connectivity. AI needs massive amounts of data to move between accelerators at, lightning speed. Marvell's electro-optics portfolio is basically the superhighway that connects all those AI chips.
Okay, let's clarify electro-optics for you listening. Are we talking about the fiber optics that essentially allow the data center to function?
Precisely. We're talking about components that convert electrical signals into light signals and back again.
So data can travel over fiber at terabits per second.
You got it. This is the critical plumbing. Without Marvell's components managing these high-speed interconnects, the entire AI supercomputer just stalls. Their specialization puts them squarely in the critical path of this huge AI CapEx build-out.
And speaking of focus, their management team made a very strategic move recently that seems designed purely to amplify this high-margin, high-growth area. Can you walk us through that automotive Ethernet sale?
Yeah, that was a pivotal moment. It was back in August of 2025. Management shed the automotive Ethernet business.
Which was a profitable segment, right?
It was, but it was lower margin and it was cyclical. So by selling it off, they did two things. One, they immediately freed up capital, and more importantly, they focused all their engineering and design talent on the core AI and data center segments.
So it's a strategic simplification. They're telling investors, we are going all in on the fastest growing, highest margin parts of the business.
That's the message.
Okay, so the story is extremely compelling. They have the moat, they have the focus. Now let's see if that narrative is actually translating into hard numbers. What's the financial proof of this shift?
The financial proof is, it's accelerating revenue and expanding margins. This isn't just a promise anymore, it's happening now.
Okay.
We saw sequential revenue acceleration all through fiscal year 2026. Q1 revenue was $1.895 billion, and that grew sequentially to a record $2.006 billion in Q2.
And that kind of acceleration is why they hit that massive 58% year-over-year revenue increase in the quarter.
Average increase, yes.
Yeah, that growth is impressive. But, given the scale required for custom chips, what about profitability? Are they getting margin expansion from this, or is this growth just expensive?
This is where that specialization really pays off. Their non-GAAP gross margins are strong at 59.4% in Q2.
And they're guiding higher.
They are.
Yeah.
Management is guiding for continued accretion, so an ongoing increase into Q3. They're aiming for 59.5% to 60.0%.
When you can raise your margins while you're aggressively growing revenue like that, it just shows real pricing power.
And a successful move up the value chain.
Yeah.
Exactly. Q2 non-GAAP diluted EPS came in at $0.67.
I do need to flag a number here for our listeners because the Q3 GAAP EPS guidance showed this sudden, really sharp jump to about $2.03.
Right.
To the average investor, that could look like a huge operating windfall. Is that the sustainable new normal for their profits?
That is a great point, and that dramatic gap number needs essential context. Listeners have to remember that $2.03 forecast, it signals the one-time accounting gain they got from selling the automotive Ethernet business we just talked about.
Ah, so it's not operating income.
It is not. The better measure of the underlying health of the business is the non-GAAP EPS guidance of $0.74 for Q3.
That makes sense. So the 74-cent non-GAAP number reflects the core operating growth, showing a high single-digit to low double-digit increase once you strip out that one-time item.
Correct.
And the cash generation, is it strong?
Very. Operating cash flow is robust at over $460 million in Q2. And that cash generation is crucial. It lets them fund their aggressive R&D pipeline without relying heavily on debt or diluting shareholders.
Which is essential when you have 50 new design wins to execute on.
You need that cash.
So the underlying business is healthy, cash-rich, expanding margins. But all of that health is entirely dependent on the continuous, enormous capital spending of the hyperscalers. Let's zoom out a bit. What defines this current battleground in AI hardware that guarantees this demand for Marvell's custom silicon?
It's all about one thing, really.
And that is?
Total cost of ownership, or TCO. The economics of running AI models at massive scale, they just don't favor buying standardized equipment anymore.
So hyperscalers like Google, Amazon, Microsoft, they're all pursuing what they call silicon sovereignty.
Exactly. They want to hedge against relying on external general-purpose chip vendors. They want to control their own supply, their architecture, and most importantly, their cost structure.
So the whole trend is moving away from buying standardized components off the shelf and toward building these highly specialized, vertically integrated stacks, where the chip and the software are designed together for max efficiency.
Precisely. I mean, look at Google's Tensor processing units. Those are ASICs customized chips, optimized only for AI math. They integrate that hardware with their own software stack.
And that co-design gives them these incredible TCO reductions.
It does. Case studies show that optimized instances using these custom architectures can cut inference costs by 50% to 65% compared to using general-purpose chips.
And that cost saving is the ultimate economic pressure point, right? That's what drives Marvell's business model. If you're a cloud provider and your competitor just cut their inference costs in half, you have to find a way to match that.
You must. It confirms that the whole era of the standardized data center server is over. The competitive edge now is in specialized silicon and the networking that ties it all together.
Which are the high-value niches where Marvell has planted its flag.
That's it. This architectural shift just confirms their relevance.
Okay, but that trend, that silicon sovereignty, it raises a challenge for Marvell's long-term story, doesn't it?
How so?
Well, if Google is building its own TPUs to reduce reliance on external vendors, doesn't that logically lead to them eventually cutting out all external custom silicon providers, including Marvell? Is Marvell just a temporary bridge?
That is the right question to ask, and it does highlight the primary long-term risk. But the complexity of a modern data center, it offers a counterargument. These hyperscalers aren't just one monolithic thing. They're constantly designing new accelerators for different purposes, for storage, for networking, for edge deployment, for different types of AI models. Marvell's strength is that it acts as an external R&D partner.
So it provides specialized expertise and a speed to market that the hyperscalers still need.
They do. So rather than replacing Marvell entirely, the hyperscalers use Marvell to handle the immense engineering complexity in specific, often niche, but still high-volume areas.
Like the high-speed interconnects or storage accelerators.
Yes, which allows the hyperscalers to focus their own internal talent on the main compute ASICs. Marvell is like a high-margin overflow valve for top-tier specialized design talent. It's just too expensive for any single company to handle all 50-plus of those design opportunities internally.
That makes a lot of sense. So let's pivot now to the technical setup and the upcoming catalysts. If the thesis is solid and the numbers are strong, how is the market interpreting all this?
Technically, the bullish momentum is quite firm. The stock is trading well above its 50-day and 200-day moving averages.
Which is a classic signal of a sustained uptrend and institutional buying.
Right, institutional accumulation. And volatility is moderate, which suggests the buying interest is stable and confident, not frantic. So based on this technical picture, the stock seems to be in a stable accumulation phase.
What are the key catalysts we should be watching for in the next 3 months that could really move the price?
The immediate focus has to be the Q3 earnings release that's scheduled for early December. Management needs to not only hit their $2.06 billion revenue guidance, but critically confirm that trajectory towards 60% gross margins.
Right. And they've also been teasing some new products.
They have. The launch of their next-gen custom AI and acceleration chips, also expected in December. A big product reveal aimed at a hyperscaler could drive a lot of short-term excitement.
And then there's the end-of-year institutional behavior to watch.
Absolutely. 2 scheduled events there. You have the ETF quarterly rebalancing in late December, which can lead to forced buying or selling. And then in early January, we get the year-end institutional holdings reports, the 13F filings, which will confirm how deeply major funds are accumulating the stock.
That gives crucial insight into future sentiment.
It really does.
Okay, what about any speculative rumors, anything floating around that investors should be aware of, even if it's unconfirmed?
There's some persistent buzz suggesting Marvell might announce a major, previously unconfirmed custom silicon partnership with one of the other top 3 cloud players,
Right.
supposedly at a high-profile tech conference in December. If that news breaks, it would be enormous validation for their leadership. Separately, there are some low-level M&A rumors suggesting they're scouting small-scale acquisitions in the edge AI space.
To broaden their portfolio a bit.
Right, to diversify their data center dependence just a little.
So we've painted a very bullish picture, but every investment carries risk. Let's spend some time on the primary concerns that could derail this whole story. What keeps management up at night?
The number one risk, without a doubt, is the company's heavy dependence on hyperscaler capital expenditure. Marvell's fate is tied to the spending cycles of just a handful of massive tech giants.
So if economic conditions or competitive pressures cause those giants to slow down their AI spending,
Marvell's revenue could contract sharply and very, very quickly. It's the structural risk of being a key supplier in a highly consolidated market.
and while they are specialized, they're not totally immune to competition. How are integrated competitors like NVIDIA and AMD challenging them?
Well, those companies are trying to internalize networking. NVIDIA, especially, is aggressively pushing a full-stack solution. Not just the GPU, but the networking, the software, everything, all designed as one proprietary system.
They're trying to own the entire AI infrastructure vertically.
They are, and that puts constant pressure on Marvell. They have to ensure their custom offerings maintain a measurable performance or TCO advantage over those integrated solutions.
We've also heard mention of inventory issues in their filings. Is that still a factor we should worry about?
It is, yeah. The company noted that some customer inventory digestion persists, so some clients are working through chips they bought previously before they place large new orders.
So it could moderate near-term growth rates.
It could. It might lead to some choppiness in sequential revenue until that inventory is fully cleared. Though, their custom design activity does provide a pretty good buffer.
So to sum it all up,
Marvell's positioning as this specialized custom silicon and interconnect provider to the world's most demanding AI builders, it gives them a unique, high-margin competitive moat. Their strategic focus, combined with the confirmed financial acceleration and that multi-year design pipeline, it all validates their role as a critical, entrenched supplier powering the AI revolution.
it's clear that while all the headlines focus on the GPU makers, the specialization required for the networking and the plumbing, that's where Marvell lives, is what truly defines the cost advantage. A fascinating analysis. To keep up with all the critical movements and shifts in the market, be sure to subscribe to Smart Wealth with Joshua. We'll be back tomorrow with another stock analysis.